Welcome to another edition of Inside the Economy. I'm Larry Howes. This time I want to talk about the job market, employment, a lot of drama in the media about jobs and what's going on there, how that affects the pending rate cut, which we're very likely to have here in 2 days. By the time you get this, we'll probably know how much they cut. The stock valuations are an issue, more of an issue than they were last time. And a quick update on what's going on in the bond market. Quick look at the numbers. ISM Service side as opposed to ISM Manufacturing. The service side is up. It's very positive. And a quick reminder, the service side of United States business is much bigger than the manufacturing side, has been for decades. It's much more important than a lot of the data you get, which is focused on industry. A lot of the collection and the biases in gathering data, and I'll get to that in a minute, is based on manufacturing, not service. And frankly, it's the service side that contributes more. It just gets kind of overlooked. Touch on that in a minute. CPI is up a little tiny bit, up to 2.9. Not bad news. It just has some consumer inflation built into it, not the least of which, and I'm sure most of you are aware, homeowners insurance and auto insurance are all going up, let's say significantly, but that's not going to slow. That's not going to stop. There's a lot of increases in all of our futures for a variety of reasons, not the least of which the multi-billion-dollar losses we've had in the last 4 or 5 years. Little burp in initial jobless claims went up a little bit. Not very dramatic. It was treated as dramatic. It's not. Unemployment is at 4.3. The entire bond market, if you look at all of the bond numbers, has already anticipated there'll be a 1/4 point cut on Wednesday, 25 basis point cut. All the values are up, yields are down. Mortgages, 6.3 this morning. It's already assumed a 1/4 point cut. They're already there. The Fed is going to cut 1/4 point. Then the debate's going to be, well, are they going to do any more this year? I should have made my opinion clear over time. I wouldn't cut now, and I wouldn't make a big issue out of starting a long series of cuts because it simply isn't warranted. We still have 3% inflation and already very high home prices. Lowering rates exacerbates both of those. Okay. U.S. private employment is fine, somewhere around 135 million people. The data is kind of complete, kind of not complete. There's a lot of people that aren't in the traditional payroll environment. They have side gigs, they drive Ubers, whatever it is. What you want to look at is what the consumer is doing, and the consumer is fine. They're not accumulating a lot of debt. They are spending their money. They have positive wage growth, not what it was, but it is maintaining itself. See a lot of input on the job market saying, oh yeah, these people are employed, but they're putting in fewer hours. I find that a useless observation. Just in our own office, any professional office and a lot of service offices, people don't spend their entire day at their desks anymore. It's very hard to measure productivity when they do work at home. Any hours of the day, you don't know how many hours they put in. It's part of the bias in the data because it's based upon a guy standing in a factory putting widgets together. That isn't where our economy is going. That isn't where the bulk of the money goes. That isn't how the consumer is impacted anymore. Don't worry about the job market. The fundamentals are the Bureau of Labor Statistics, the head got fired here a little while ago, and it's going to come under a lot of scrutiny because of things like this. They have put these big, huge negative corrections in their estimates because they come out and said, well, they are estimates, and we're lowering the estimates. And people point their finger at them and say, well, most of your estimates are way over, so you must be bad. Their phone surveys. In fact, the Bureau of Labor Statistics spent $640 million last year. That's their budget. I don't know how many employees they have, coming up with these numbers, and they're just adjusted back. I think there might be some, really, is this a good way to spend government money? Monthly U.S. jobs, small increase. All we really needed was a small increase because we made up for the adjustments in new manufacturing expansion and how things changed during and after COVID. Well, this is positive in U.S. jobs. Government jobs, you notice, are going the other way. Some of this is reflected in the initial jobless claims now because there's a lot of government agencies that are, well, letting people go. Remember, the budget is a big deal. The stock market, they're not listening. I mentioned last time and before that we're overvalued. We are overvalued. We're about 16% overvalued as of today. And the S&P 500 futures were up again this morning in anticipation of a rate cut. It's not like it's news to anybody. It's not like there's valuation problems anyway. We are overvalued. The S&P does not have the earnings to support these valuations. Then the NASDAQ, the small companies, has gone up way up again. They need to correct, and they will correct. Probably based on the lack of the Fed's interest in continuing to cut rates after Wednesday. That's just an estimate, but they need to come back. It's not bad news. It's not a bubble yet, but a correction is just mandatory. Where our valuations, I mean, we're at 27% price to earnings. It's just way too high. Correction would be nice. As efficient as U.S. industry is, and most of this is just non-financial companies, not banks. Across the board in the S&P 500, corporate profits are pretty good. They are great. We know that. The valuations have gone past what this is really worth. And the glory of artificial intelligence and how important chip manufacturing is and a few other things like that that have really gone over the top are going to have to correct. And they will probably, these specialized things, NVIDIA and those guys, Oracle, they will correct in a big way. It's okay, they need to. U.S. manufacturing, they say, American manufacturing is falling apart. No, it's not. It is adjusting to a new environment. This is really where it's been. This is basically ISM numbers. A little under 50, meaning they're sort of neutral, not expanding, kind of contracting, going sideways. They are changing. More robots. They don't have lines of workers waiting to get a job, and they're not looking for lines of workers. What they have is what they have, and they're glad for what they have. They're paying these people a lot of money, and they're automating more. It's not rocket science. We are starting to see some of the result of the commercial real estate market after COVID. Do you really need malls? You know the story. We're starting to see some problems with some mortgages. We're not talking about delinquencies yet, but we're seeing a lot of large commercial real estate deals that they're going to have some problems with their banks and whoever's financing them. Where do you speculate in commercial real estate right now? Do you want to buy a mall? Do you want to buy a strip shop with 25 retail stores in it? The franchises are still in the process of coming apart. It's likelihood that Panera Bread will go under and so on and so forth. So the speculation and the risk you have to take in the commercial real estate market, yes, office buildings too. We're just starting to see that right now. On the positive side, certainly in the bond market, just as an update, those of you that used to spend a lot of time in the commercial paper, if you remember the conversation, what's going on in commercial paper, short-term corporate, like covering payroll paper. That was a very popular, very lucrative market before 2008. And all the counterparties were part of it. Well, the commercial paper market is coming back. They've done about $200 billion so far this year. And that's a good number. As representative, the short-term treasury bill market, 3-month bills, the short-term between banks for money markets, so on and so forth. They trade $100 billion a week. That's how important treasuries are. The entire world trades in treasuries, and there's enough room to get the commercial corporate paper market back. It's very positive for the bond market, very liquid, so on and so forth. And they're looking at a nice marketplace going forward on the long-term perspective that rates will creep down. Even if it's only a point in the next year, don't hold me to that. Even if it's only a point, the bond market's looking pretty good and very liquid. Finally, question. Somebody asked me, well, you mentioned there's a lot of countries out there that really can't feed themselves and that some of that is getting worse. Well, that's quite right. China especially, considering the flooding they've had and the dam losses and so on and so forth, they lose a lot of arable land along the rivers that have flooded away. Pakistan is bad. We don't know what the food market is going to be like next year. It won't have an impact until next year. But the United States, and the question came from, aren't we a net food importer too? Well, yeah. The difference is China and Japan and Egypt and countries like that have to import the absolute basic wheat or rice just to eat. We import food mostly because we want fruit and vegetables, every type everybody likes, year-round. And very fresh. And very fresh, hard-to-get fish. That's what we import. Fly it in mostly. There's only a handful of countries on Earth that have the kind of food availability that you have here. Anyway, that's not a political statement. It's just we're a net food importer just to convenience ourselves. Okay, well, that's enough. As always, send questions along to info@shjwealthadvisors.com. Happy to deal with them. And thanks for joining me.